The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers, certified financial planner practitioner. I'm president and founder of Akers Financial Group. Here on the show today, we have Mark DiOrio, Chief Investment Officer at Brookstone Capital Management, which is one of our third-party money managers. And today we're having a great topic, and that topic is the mid-year market update. And we're going to have Mark DiOrio come in, and we're going to start talking the stock market today with lots of things prepared for you guys. Hopefully, you're going to enjoy and learn about the stock market and what's been going on. And later on, we'll talk about what's going to happen. Mark DiOrio, good morning.
Hi, Brian. Happy to be here.
That's awesome. I'm glad you could be on The Voice, even though you're even in Chicago right now, right?
I am. It's been a great summer in Chicago.
That's cool. Now, Chicago is the home of Brookstone Capital Management, and you serve as the Chief Investment Officer there. Tell us a little bit about yourself and about Brookstone Capital Management.
Sure. I joined Brookstone Capital Management in 2015. And so in my role as Chief Investment Officer, I lead the firm's investment committee. And what the committee does is drive the firm's investment policy and portfolio construction methodology. And so from that, really, I'm reviewing external money managers and also developing internal strategies. And then from that, I'll produce content from our research and our research team that really goes out to both our advisor community and our investors. And then Brookstone Capital Management has been around since 2006, and we've just surpassed $7 billion in assets under management. And as you mentioned, we're located right outside of Chicago, and actually there's a small community here that's actually been building, is really the financial community that might be familiar or sometimes may be familiar with others across the nation. But from an academic standpoint, I've received my BA, MBA, and then my Chartered Financial Analyst designation. And I have a little bit over 20 years investment industry experience.
Yeah, that's great. Brookstone has had incredible growth, and under your leadership, the investments have done very well. So we're honored to have you on our show today. What we want to do is ask you the main question, which is what's been in the market the first 6 months of 2021?
Well, it's been very interesting. We've really had a continuation of the recovery that started really in April of 2020, following the very extreme and very quick pandemic-related driven sell-off. So that was really a shock to the system and an exogenous shock. So the market started to rally back and recover based on maybe we'll get over this challenge in the future coming into 2021. And so the rally in stocks has continued. We've seen a little bit of rotation in the market, meaning last year what was very popular were technology and growth-related stocks that led the market higher. And this year we've seen a rotation into some value-related stocks, and value-related stocks are really a little more levered to the economy doing well. And so sometimes people think that growth stocks do better if the economy is growing quicker. It's just the opposite. Value stocks actually do better when the economy, the underlying economy, is growing more. And growth stocks do better when growth is a little bit slow because they're trying to find companies that can grow regardless of the market. So we've seen a rotation into what they call cyclicals, some industrial names, actual traditional companies, if you think of it in that sense, and financials, banks, and so forth. What we saw in the first quarter was a pretty big sell-off in bonds, actually, where interest rates rose. So the price of bonds move inversely with the direction of interest rates. So if interest rates are rising, bond prices are falling and vice versa. So we came into the year and the 10-year Treasury, which is kind of a key benchmark level, was at about 0.93%. And as the economy was coming back, people got a little more optimistic, so we're expecting higher inflation and higher growth in 2021. So rates started to move higher in anticipation of that. And so we saw a pretty sharp sell-off in bonds in the first quarter of this year, where the Treasury went from 0.93 to 1.74. But since that time, interestingly enough, as we closed out the second quarter, rates have moved back lower below 1.5% and are sitting closer to below in the 1.3% range. So it's really an interesting indication. The big fear that has really kind of touched the market, or the concern I should say, is that inflation is growing faster than anticipated. And that's something we're going to keep an eye on and something we have some thoughts on going forward.
Right. So I guess with the stocks, in 2020, I believe it was led by growth and the FANG stocks and a lot of the COVID stocks, I guess you would call it. Have you seen that change here in the first half of the year?
Well, we have. So we saw early on, particularly the first quarter, value stocks were outperforming. So that kind of trade of the stay-at-home stocks, some of those hot stocks of last year have really faded relative to the overall market. And I would make a separation between the FANG, which is Facebook, Apple, Amazon, Netflix, Google, kind of these large companies that are household names now, versus some of these new up-and-comer stay-at-home stocks. The stay-at-home stocks were hot for a little while, but they've definitely cooled off and remain kind of below where they were at, or some of that excess speculation has worn off. However, we do see a resurgence in those large cap tech names because people are familiar with them, think they're a little bit safer way to play technology overall. So it's a very interesting mid-year point that we're at, where we could have said, or if you asked me a couple months ago, we would have said, yes, value is going to lead the way. But that started to transition to where now it's kind of split. There's not one leading the other at this point.
You know, there's been so much going on in the first half of this year. I guess that we should start with the basic idea of the unpleasantness, the COVID situation throughout the beginning of this year. How would you say that has affected the market?
Sure. I think it affected the market last year in such an acute manner, and as I mentioned, it was an exogenous shock. I mean, it wasn't the natural economy slowing down, excess inventory causing a little bit of deflation and a slowdown, a normal recessionary type environment, or overheating that leads to a big cool down. Here was a shock, but then what we did was we shut markets down, or shut businesses down, shut borders down, and then left the markets open. So the only place to get cash was really to sell securities if you had to in the market. So the markets bore the brunt of immediate need for cash. And then after that, the Fed, which conducts monetary policy in the U.S., came in, as they do, to help support markets to make sure liquidity is enough to have a functioning capital market system. Now, that's normal activity. Sometimes you'll hear commentators criticize that, but that's one of the main reasons for the Federal Reserve, which is to make sure we have a functioning financial system for the benefit of everyone in the economy, essentially. So they came in and they did that and helped support financial assets by injecting money, buying some securities. And then we saw fiscal policy, which is conducted by Congress and the government, and really come in very aggressively with fiscal stimulus plans. So that really gave a boost in the market, kind of a 1-2 punch that made us lift out of this COVID-driven era that was having this impact on the markets. So that's been a tailwind for the markets. Underlying that, and what the market was basically saying was, we're going to get through this, and on the other side, things are going to be better, going to be good for business. And now I think you've seen the realization of that in 2021 with faster economic growth, better business environment, and earnings have been much stronger even than the market was anticipating. So at the moment, as we get to mid-year, when we look at earnings growth, it's about as good as it gets for stocks, and that actually has some implications as we look out going forward as well.
Yeah, so the stocks, like you were saying, as good as it gets, that's definitely a topic for later in the show. What we want to do is talk one last subject, which I think a lot of people have paid a lot of attention to, and the effect of cryptocurrencies on the market in the first half of the year.
Cryptocurrencies are a very interesting kind of corner of the marketplace that's really developed, and there's a lot of misunderstanding around cryptocurrencies and what they are. The biggest one and the initial one was Bitcoin, and still is Bitcoin. It's the largest by market cap. But we see this as an emerging asset class. So it's very volatile. We think it's going to continue to be volatile, but it actually has some properties that other traditional asset classes do not have. And what happened with the inception of Bitcoin, which is around 2009, and it took several years for it to even have a marketplace for it, or a secondary market where you see trading and then actual value to the Bitcoin and exchanging hands. It took a while for that to gain hold, but then several years later, a number of other cryptocurrencies were launched and almost created this whole crypto economy or ecosystem. Now, not all of them have the same properties that Bitcoin, for example, does, but usually Bitcoin's the first one that you'd be introduced to, and then you'd look at the others and what properties they have. And I don't know how much we want to go into the different properties, but I would say that it's an area that we're definitely keeping an eye on, but be mindful of the volatility, and very large volatility is normal in that market. So we're not really thrown off by the heavy volatility, the big run-ups, the big drawdowns. That's going to happen in that space because it's, like I said, a new asset class, and many of the use cases are maybe several years out for some of these. And so it's an area of speculation. And there can be nothing wrong with that in terms of what the market's doing, but I wouldn't get distracted from when you're building a portfolio based on long-term data sets that give you a little bit more quantifiable data and predictability in your portfolio.
Yeah, basically what you're describing is that the risk outlook on the crypto side is still high to the future before it's really broadly used. But it is making its way as another asset class, which I think is something for people to consider long term. The idea of the first 6 months of this year, would you call it just an incredible beginning of a year, or would you call it a little bit going too crazy? What's your quick answer to that? Was it been a great year or almost good year?
I think it's been a great year so far, just that continuation that started last year. And so that's where I would
thanks
put
for that. Yeah, I want to get that quick answer. Is it thumbs up or thumbs down? Because I think it's interesting to sort of, as you sort of round the halfway pole of the year, to see, well, what was the year like so far? And then the second quarter of the show, we're going to talk about where we think we're headed. All right, so many times as you're getting ready to retire, you got to think about what's important to you. We want your biggest, at Acres Financial, we want your biggest worry of your day to be where you're going to drink your cup of coffee, where every day seems like a Saturday, free of the stress of trying to pursue and try to accomplish and be able to become retired. There is a chase for that. Your retirement income will be taken care of by Acres Financial Group. It's the future you want. It's not too late. We want to help provide this kind of retirement. Begin by calling Acres Financial Group to schedule your free meeting at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and Susan will call you back on Monday to schedule in-person meeting, a virtual Zoom with one of our team of advisors. Give us a call at 833-946-7384 or visit us at acresfinancialgroup.com. What is the outlook for the third quarter? We'll talk about that in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hey, welcome back. I'm Brian Akers, certified financial planner practitioner from Acres Financial Group, and host of Winning in Retirement. Today's show is the mid-year market review when we brought Mark DiOrio, the Chief Investment Officer from Brookstone Capital Management, in to give us a market review of what's happened so far. Now, here in the second quarter, we got a tough question for you, Mark. I hope you're awake and ready for this one. What is the outlook for the third quarter, Mark DiOrio?
Well, let's jump right into it. So I made a comment last segment, which was it's about as good as it gets for stocks and earnings in particular. Meaning when we look back over the last 40 years, what do forward earnings look like? How optimistic, how good do they look? How do companies and businesses look going forward? Well, year over year, they've grown at such a fast percent. And part of that is because you had such a big drawdown, of course, because of the COVID or the pandemic-related shutdowns. This is about as high as it's gotten historically, including the period right after the global financial crisis. And to make a big difference between the two is simply the global financial crisis was a long, drawn-out affair, but it did really negatively impact earnings. And then you had the pandemic, which was very sharp but short. But when we see these rebounds, this is about as high as it gets, which means that maybe the market has discounted all the good news at this point, and now that the economy is reopening, now maybe a little bit of reality sets in where we have to look at what are the normal type of earnings growth that companies can generate in this environment. Now remember, we had the stimulus that helped the markets and helped the economy recover. When we look out from this point forward, the stimulus effects are fading, even though there's still some stimulus in play, but both on a monetary and fiscal side, they are definitely fading, and maybe even a negative headwind for businesses and for the growth of earnings going forward. And I think that's a big point, because that's going to come up and we're going to have to deal with that reality shortly. Now, there's an infrastructure bill, but the infrastructure bill, regardless of what the headline number is, that's going to be spread out over several years. So we don't think it's going to have a big impact on, or maybe in pockets, but a minor impact on the overall economy or earnings growth. And then the third thing to consider is that China's having a very rapid slowdown. It's hit their economy. It just hasn't spilled over yet, and we'd expect some of that to come into play. And this leads to the inflation outlook, which would say the big concern has been, oh, inflation is running pretty high and hot. Well, inflation always bounces pretty high after kind of a recession. Why? Because you're reopening, demand increases quicker than supply can come back online. So you see this big jump in the inflation numbers, but we don't see it confirming globally. In other words, the US is the outlier, where inflation in Europe and Japan is still very low. So we think the US it's a blip, and inflation's actually going to come down because you have China slowing, fading stimulus package, and you have earnings starting to cool off as well. So it's a much different environment than I think the first quarter. And one of our points was, well, bonds, even though they yield very low, can actually have pretty good relative performance to stocks in the third quarter. And the third quarter has also been one of the weaker quarters for stocks. On balance, it's been positive, but August, September has actually been the two weakest months of the year when you look at the calendar seasonal year.
Now, you said a lot of interesting things there. You finished up with the third quarter is seasonally has a negative, more possibility of negative than the rest of the year. But isn't generally throughout the year the market is more than 50% of the time positive throughout the year?
It is. So it's around 62%. And the third quarter happens to be just the weakest in terms of performance. Sure. When you look at these averages. So they're seasonals, they don't work every year. They're just something to be aware of when data lines up. And so we'd say, maybe some data lines up here with some seasonal weakness, and maybe the impetus is some of those points that I was referencing.
Right. So there's some other things you're mentioning is about the inflation. I know Social Security is talking about that the Social Security inflation rate being maybe 5% or more when they raise Social Security for the next year. That's based on energy prices and other things. What's your opinion of interest rates and inflation when you combine the two?
I think you have a big disconnect, and it's going to be a big disconnect for years in regard to the interest rates are not reflecting the inflation rate. Historically, you'd want interest rates above the rate of inflation, or at least at the rate of inflation. Otherwise, interest below the rate of inflation would tell you you're earning a negative yield. So if you have money in your savings account at the bank and it's not paying anything, but you have inflation at 5%, well, that's a negative 5% real return. And that's one of the reasons why you build a diversified portfolio, is to maintain and grow your purchasing power over time. So that takes into account the effects of inflation, the ups and downs. And remember, inflation has been a constant for years, but it's very slow. So it's, a couple % per year, but it keeps growing. And then it depends on your consumption basket. as well. So some of the numbers that you see may not reflect your particular, or even your demographics, particular inflation that you're actually realizing, because things like education, homes, cars, healthcare have all risen at a much faster pace than the inflation rate, and those are all things a lot of us use and pay for. So it's important to look at that, what's in that inflation data. So interest rates below the rate of inflation, we actually think that that's the policy of the U.S. To keep interest rates low, to allow the economy to grow, and to be okay with inflation being higher than we've seen it over the last couple of decades. So it's a real interesting environment, but it poses a specific challenge for investors, particularly savers, to make sure that they have a well-diversified portfolio to overcome that inflation over time, but also do it in a risk-thoughtful manner.
Yeah, absolutely. So let me try to break down what I heard. There's this thing called but a real rate of return. And real rate of return is if you earn money and you pay taxes and you got to keep up with inflation. That's like a rate of return that sort of makes you break even based on year over year is a real rate of return. So trying to beat inflation is like the minimum goal of an investment when you're trying to seek growth. And what Mark was saying is that interest rates set by government policy are going to try to keep those rates lower because of the deficit and the rising deficit that we have. I think this might be a long-term policy. Thus, anything on the short-term interest rate wise is not going to give you a real rate of return above inflation after tax. And so that drives us into other kinds of investments to get the real rate of return. When you're thinking about the third quarter, you were saying the markets are high, the earnings are at their high. Is there a way to think about the markets, a way of thinking about where to put money? I know we're going to get deep into that in the second half of the show, but when inflation is really starting to kick up, is there just certain areas that are automatic things that we should look at?
Well, I think over time, equities have definitely outperformed inflation, and that's one of the bases for investing and allocating to equities. On your bond side, you have to think about that in a different manner because rates are going to be below the rate of inflation. So what you have that there is to diversify your equity exposure. So this makes mixing that combination really important, meaning you don't want to go too conservative because you might be exchanging one risk, volatility. Usually when you're going conservative, you're really referencing, well, I want only a small amount of volatility to get my return. But if you take a too conservative approach in this environment, well, you'll be losing to inflation. So you want to make sure you calibrate that correctly. And if you take too much equity risk, well, your portfolio could be too volatile, and then you run the risk of it just being too volatile at the wrong time or very challenging to hold. So calibrating that makes a lot of sense, as well as thinking about really good diversifiers. So people might be familiar with stocks and bonds, but you also want to add other ideas, other income generating ideas to portfolios, whether you look at real estate investment trusts, those are publicly traded ones that I'm referring to, and then dividend-paying stocks and all across the board. So you want to open up the asset classes that you may not be familiar with, but may add some value to the overall portfolio in either a combination of risk reduction or income enhancement.
All right, so in this third quarter, is it true that we can keep up with the bull market that's been going on, or is this like a pause in a bull market? What's your general thought on that?
I would say a pause. We think we're in a secular bull market, meaning a long-term bull market, and it's driven by the ultra-low interest rates, number one. Number two, buybacks. Companies continue to buy back their own stock, which is shrinking the supply of stock outstanding. So all the large companies are doing this. In fact, we'll have a record buyback most likely when they report data from the second quarter. So these are companies using their cash to buy back their own stock. And so that has been a theme that's played out over the last 10 years that's really, we think, have given a boost to the stock market, meaning they're shrinking their shares outstanding, as opposed to issuing shares, which would put more supply into the market. So this took a pause last year, but it's come back in earnest this year. And then third, we really think that productivity growth and economic growth is going to be better than anticipated, and it's driven by these disruptive technologies that became popular last year, and we started to use certain web-based video and work from home. We thought that we probably used as much of that as we would have 5 years from now. In other words, it became part of the business landscape, but it wouldn't have otherwise come for another 5 years unless the pandemic hit and we were kind of forced to use it, and we did. And if you look at the data, productivity really took a spike this last couple of quarters, and that drives economic growth.
Right, so that's a secular bull market, is a long-term bull market, but there is pauses and even pullbacks throughout that period. Mm-hmm. So if the general trend's positive, that means patience. And then one of the biggest things I got out of this second quarter of the show is being diversified. Being diversified is almost the opposite of people chasing the high market and stocks that are already at all-time highs. Now, at Acres Financial Group, we're local, we're independent. We don't report to the company on Wall Street, we report to you. We have offices in Forest Hill and Lutherville. This is all about your retirement. We want you to be winning in retirement. Give us a call at Acres Financial Group to schedule your free meeting. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, just leave a voice message, and Susan will get back to you on Monday to set up an in-person meeting or a virtual Zoom with one of our team of advisors. Start planning for your retirement now by calling 833-946-7384 or visit acresfinancialgroup.com. Where do you invest your money right now? We will answer this in the second half of the show.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, president of Akers Financial Group, and here with me today is Mark DiOrio, chief investment officer at Brookstone Capital Management. And he's been in the financial services industry over 20 years, and he's here on our show today to talk about the stock market. He's given us the mid-year market review. He's given us an outlook for the third quarter. And here in the second half of the show, we're going to talk about the following, and that is this. Hey, Mark, where do you invest your money right now?
Sure. Well, I think I would back up and zoom out just to have the right context to answer that question, because I think this is important.
Sure.
I always get asked, what's the best investment? Well, you don't know what the best investment is until hindsight. And so we use a process called risk-appropriate investment strategy evaluation. We call it RAISE. But really the most important word is appropriate. So what's the most appropriate investment or portfolio for you? And we don't look at investments as one-offs. We look at them as a component in an overall portfolio. So some investments you may think, oh, I don't like that investment, but then you put it into a portfolio, maybe it complements an existing portfolio really well, and the risk and return statistics improve. That happens very frequently when we build what we call multi-asset or multi-strategy portfolios that are doing, you have a number of different strategies that are doing something a little bit different, but then when you put them together, it really makes a nice comprehensive portfolio that gives you nice risk and return statistics. So we build an entire roster based on an open architecture approach, which what that means is we don't necessarily have proprietary products per se. We look at what's the best of breed in the different categories. What's the best large cap stock manager, or growth manager, or fixed income manager, or ETF, exchange traded fund, or mutual fund? What would make sense in the portfolio? From there, the investment committee builds a whole suite of investment models that are designed to line up with your risk profile. This gets to the appropriate. So are you conservative? Are you moderate? Are you aggressive? And then from there, we make sure we identify your investment preferences. So some people have preferences for investing one way over the other, and we don't really, as long as it's sound construction, we think there's many ways to attack that issue of what's the appropriate portfolio, what's your investor preference. So we build them based on your preferences. So it's not a right or wrong decision necessarily. So for us, where's the best place to invest for the third quarter? It's in a risk-appropriate, well-diversified portfolio that's consistent with your investment preferences.
Right, and I think this fits very well with the Acres Financial approach, where we start with a person's financial fingerprint, which is getting to know them, their goals, where their assets are to start. And then what we build from there is how to create an investment plan, an income plan that'll meet their needs for a lifetime. And that's why we started working with Brookstone Capital Management as a third-party money manager for Acres Financial Group back in 2013. We use Brookstone Capital Management to provide a broad number of portfolio management tools that we can design and add into a portfolio. And through technology, we can have an account and have multiple management inside of them. They're called sleeves. So, Mark, I think that's allowed this to be a lot easier in managing money, is to be able to stack different styles together in one account for a client, so they're not spreading their money in multiple accounts. They can have it all in one place, right?
Definitely, and this isn't consistent across the industry. We've worked really hard on the technology front to allow what is called a UMA, or Unified Managed Account. I mean, it's one account, so you don't have multiple accounts, but you can have multiple strategies in one account. So it makes it administratively easy for the client, but also allows for the advisor to have all the tools in the toolbox to be able to use and implement in the portfolio. So we run a lot of different sleeves or strategies, and some of them work in a portfolio for one client, but another set of strategies in those sleeves work for another client. And that gets to your fingerprint, Brian, which is the appropriate strategy in which situation. And so we run from dividend-based strategies to hedged equity strategies to model portfolios. And what we talk about a lot is kind of a core satellite allocation framework. So when you're thinking about investing, you'd say, okay, I have some ideas or things that I might like, but you like them in a small percentage. And so that can be in your satellite sleeve, while at the same time you can have your core portfolio, which is well-diversified, again, consistent with your risk profile. And we sometimes call that a model portfolio that's designed by the investment committee.
Yeah, it makes me think about when we're talking to new clients and some of the thoughts that they have when we start our initial meeting. Recently, I've had people say that, all I need to do is buy an index and I'm good when it comes to investments. And that's sort of like against my core belief. What's your opinion if someone would say, I'm just going to buy an index or two for all of my money? What's your opinion there?
Well, there's a couple of thoughts there. One, indexing can work well in certain categories, and we do blend some of the index strategies, but we don't end there. We think you're missing a large part of the opportunity set. So a good example would be a stock last year that was very hot, Tesla. Well, Tesla was not in any index until it was one of the 10th largest companies in the U.S., and then it got into the index. In other words, and since that time, it's been okay or kind of moved up and then back down. But you missed the entire run-up because you were indexing. Whereas if you had an allocation to an active manager or what we call thematic, a theme, that you can add in your satellite allocation in disruptive innovation or disruptive technology, you could have held Tesla for that entire run as a component of the overall portfolio. It's not a pitch for Tesla. It's more an example of what indexing has blind spots. Now, the other part is that it doesn't allow for maybe hedging or reducing the risk of the index. And then if you look at other asset classes other than large cap blend, the other asset classes you'll actually find better performance in active management. And one big one that gets missed all the time because it's not really sexy to talk about, but is in the bond category. So bonds represent a big portion of investors' portfolios, especially in the pre and retirement categories, meaning you're going to own more and more bonds. They don't move with the stock market, they move to the bond market. And we found that the aggregate bond index, which is kind of the broad index, active managers have consistently outperformed that and added value over time to that index. In addition, right now you see that index assuming more interest rate risk, meaning if interest rates rise, you'll see more downside to that index.
Now, the concept of core strategies, how does that compare to target date funds?
Sure, target date funds is where usually you'll see it in a retirement plan. Maybe it says pick the year of your retirement or closest to your retirement, and let's say it's 2020, for example. You picked a 2020 fund, and the idea is it's an asset allocation, so it has a combination of stocks and bonds. As you get closer to retirement, and then in retirement, you're selling stocks and moving into bonds automatically. It's based on time, not the outlook for the asset class. So what was happening in 2020? Well, that fund might be, because the goal is it's planned for someone retiring there or about there. You're selling stocks into the drawdown in stocks as they're declining, and buying bonds when they're at very low yields, which is essentially locking in those low yields going forward. So you've done the exact opposite of what you would have done if you would have taken a step back and actually said, wait a minute, stocks are down, that's more of a buy, and bonds are up or yielding very low, that sell at that moment. They were doing the opposite. And this has happened before. The 2010s, right during the global financial crisis, those strategies are selling stocks and buying bonds. We just don't think that's the right strategy here. It's called an industry glide path. Most, if not all, the funds really have this kind of design. And so we look at it and say, you want to build that core portfolio, but then consistent with your risk profile. And then we'll look at the outlook for the different asset classes and not just do that on an automatic basis. But you can reduce your risk or increase your opportunity in the satellite allocation, which is really complementing doing things a core model wouldn't do. And so one of what I mentioned was maybe you allocate some to disruptive innovation. It's almost a new segment or a segment to itself because a lot of those stocks aren't in indexes. And that's where a lot of the growth is actually happening in a lot of the kind of the hot stocks, if you will. But hot is not a bad word. It's really telling you, hey, this is an area that has above average potential, and sometimes it gets overheated. But at other times, it may be overheated for the right reasons, meaning the outlook is so good. And so that can give you exposure there to future growth companies. And then you can also add some different holdings to increase the income out of the core portfolio. And so the satellite is the right place to do it, we think, where you wouldn't lose good, sound portfolio management discipline.
Yeah, that sounds like great advice for all investors. Now, the way we at Acres Financial Group try to work with clients is we try to start with them. Where are they now? And we want to add purpose to the money. Now, the purpose to the money means, what do we want to do? Pre-tax it? Do we want to make it after tax or tax-free in the future? This creates different types of accounts. And then what happens is you guys might own a personal account, a Roth IRA, an IRA account, 3 separate accounts. And then in those accounts, you have different risk tolerance. They truly have different, different time horizons also. And so those time horizons dictate how we invest. At Acres Financial Group, we want you to be taken care of throughout your retirement. We want you to have your time back. Because as you're working, your time's eaten up by other people's demands, by other requirements. You don't get that time to do the things that you might want or the things that you would love to be able to do. So winning in retirement is where your investments are taken care of. Things are allocated, diversified, and handled to be able to provide throughout the retirement years. why don't you give us a call for a free meeting at 833-WIN-RETIRE. That's 833-WINRETIRE. That free meeting is where we'll sit down and talk about where you are and really try to figure out how we could help you reach your goals that you have. Give us a call now at 833-946-7384 or visit acresfinancialgroup.com. Are you taking more risks than you need? We will explain in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hey, welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner practitioner from Akers Financial Group. Now, here on Winning in Retirement, we have our website, and that website is acresfinancialgroup.com. When you go to that website, we have a radio tab. On the radio tab is all of our past shows, and next week we'll have this show on the website there, so you can go back and hear maybe the first or second quarter and find out about the markets, or maybe the third quarter and finding out about investments and diversifying. There's just a lot on that on their website at acresfinancialgroup.com. Today's show has been talking about mid-year market report, and we reviewed the market, and then we're trying to finish up here with how do we invest our money now when it comes to this environment. So we're going to welcome back our person today, our very special person, Mark Diorio. Mark, have you ever been called a special person?
Well, only by those who love me.
Yeah. Well, I guess I didn't really love you until you did the Mike Ditka impression one day, and then when I saw you in your full outfit meeting the actual Mike Ditka was probably one of the highlights of my life. All right, so here, actually not, but it's funny. Mark Diorio is Chief Investment Officer at Brookstone Capital Management. He's been in the industry 20 years and been with Brookstone for a little over 6 years, and Brookstone Capital Management manages about $7 billion now. And so that's a lot of work, a lot of things going on. But as a CFA, it sure looks like you're doing a great job for our clients, Mark. So I want to ask this a tough question as we head into this. Mark, are you taking more risks than you need? What I'm talking about is a client. What if they're taking more risks than they need? What do you think as a portfolio manager?
Well, I think you're given a great opportunity right now to really rethink your portfolio allocation and redesign it if necessary. So by that I mean the market has really bounced here. It's been a very big run off the bottom of last year, and if anyone asked you or asked me, hey, what do you think about the market being at this level in a year, I'd say that's a great situation given where we were in the first quarter of last year and the unknown challenges that we were facing. So I'd say the market's given you an opportunity now that maybe you have some gains, and maybe some of those gains are bigger than you were expecting, to say, okay, the market's going to really dial back into reality in a sense. You have some of the monetary and fiscal stimulus fading away, and the market's going to have a more normal type of trajectory going forward with some blips along the way. So given that we know we've had that nice run, now's the time to be able to peel that off if necessary. Now, your goal is to, or your job as building a portfolio is and for us is to get you to your goal, taking the least amount of risk possible. And so sometimes investors don't realize how much risk they've taken in their portfolio to get them to a certain point. And this might be a good opportunity, because what I've seen recently is maybe some folks speculated a little bit with the big drawdown last year, and now they have big gains and they're not sure what to do with them. And it was really just a speculation. You know, they put some money here, it worked out because the stocks bounced or had a big rally, but now they want to make sure that it's in a diversified portfolio. And by that we mean looking at all the different asset classes and really giving you ability to quantify your risk and return. That's really hard to do with an individual stock or just a handful of individual stocks, for example. And if you're just in stocks, well, maybe missing the benefits of when you add different asset classes, you actually don't reduce your return that much, but what you do mathematically is that you reduce your risk, and that's pretty key to building long-term wealth and also having a portfolio that's what we call enduring, meaning if you had to take money out or if you're in the withdrawal stage, you can really plan to take those withdrawals out confidently.
Yeah, Mark, when I think about things, what I think is about people who've had that great growth on certain stocks, certain investments, and they don't want to sell because they have to pay tax. And what I try to explain is that the capital gains rate is a lower rate. Right now, that tax rate's a great rate, and we got to take some winnings off the table and to diversify and build that full-bodied, that full portfolio out for the rest of our life. We got to take some winnings off the table to do that at times, and now is exactly what you're saying, is the time to take a look at where you are, what your allocation is, what is the risk level that you're taking, because if you had your investments on the risky scale, you might be out of whack when it comes to proper allocation. And as you're getting closer to retirement, especially in that last 10 years of getting ready to retire, you got to look at, are you too risky with your money? Because if there is a big pullback here, we don't want to see you lose some core money you need to live off of. So I think timing, the taxes are all part of this investment decision. Now, the outlook to the future with the Fed and how they support the stock market, the inflation, the interest rates, the market outlook. If people are investing, I think you're coming across by saying that they really need to diversify over the next few years to make money on their money. Would that be a fair answer?
Oh, definitely. So we've really embraced the idea that diversification and multi-asset strategy diversification is really probably the most thoughtful way to go about this challenge, because you have ultra low interest rates, but you still need bonds in the portfolio, so they have to play a role. And then you need things to help complement that organic income coming off the portfolio. And some of those could be in high quality dividend paying stocks. That could be a sleeve in the portfolio that we were mentioning. That could be one of the strategies that helps to do that. And they're almost a different subset of stocks, and people sometimes lump them together with value stocks. But these are stocks that really have a history of paying and raising their dividends to shareholders over time. So it's not a hot stock type of strategy. It's really an income-based strategy, knowing that it's equity that you own and not fixed income. But it also provides the potential for capital appreciation, which bonds really do not, other than the ups and downs of interest rates. And so we'd say, look at all the asset classes. International has underperformed U.S. for a long time, and so the valuations there are really low relative to the U.S. And so that historically that has flipped back and forth. You'd have the U.S. outperforming international stocks, and then the international stocks outperforming the U.S. stocks. The point is, where you can really what you can really rely on when you start to include multiple different strategies is that they all move kind of differently, and then when you combine them in a portfolio, they end up reducing the overall portfolio risk. And this gets missed a lot of times unless you're dealing with this and running the math behind it to say, oh yes, it does. These holdings do complement each other very well. And that diversification is kind of your buddy through this.
Yeah, that downside protection is very valuable for retirement planning, because we don't want to go back to work. What we want to do is to maintain our lifestyle through the good and the bad, and that's why we use protected investments like annuities to help offset investing in bonds. Do you have a quick opinion on that kind of concept?
Oh, definitely. So we're very open-minded in terms of how you're planning. In other words, some people take sides on different asset classes, and we really try to look at the merits of different investment vehicles, asset classes, and how they work to allow you to hit your goals. And then in this low interest rate environment, when we've looked at the data, you'd say, geez, annuities really have done fairly well relative to the low interest rate environment. So we definitely think that's a viable component for longevity reasons, but also from a traditional portfolio evaluation side, that it plays a role and is designed to do something and has features that other asset classes do not have.
All right, Mark Dorios. So we've had we've had a radio show talking about the mid-year review. I want you to give like your final summary of 2021. What is your final summary of what you think about 2021 so far?
Well, I think it's the second year out of a big bounce, out of a big shock to the economy. And so we've gone up with this big optimistic wave, but I think we're going to turn and some real challenges are ahead of us. And that's not a dire situation. It's just a more challenging operating environment that requires a little bit more thought of how you combat low interest rates, inflation, and maybe the challenges the economy might face with the reality of the reopening and some lingering effects with the pandemic.
Yeah, I believe you're exactly right when it comes to where are we at. It's almost like we're all coming back out of it, getting back to work and full tilt, and we're going hard. One of the things you said earlier is that demand is outpacing supply right now because we got to catch back up. So the economy is going to be a little volatile through all this, and so we really need to build a solid financial plan, well-diversified, to handle the good times and the bad times throughout this. Mark Diorio, thank you very much for being on our show today.
Thanks, Brian. It's been a pleasure.
I really appreciate that, and keep up the good work. We thank all you for listening to our show. If you missed any of it, go to our website at acresfinancialgroup.com and check out our past shows and even this show as it gets applied to our website very soon. We want you to always be winning in retirement. So take this opportunity to begin planning with us at Acres Financial Group. Go ahead and schedule a free meeting by calling us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, you leave us a voice message, and Susan will call you back on Monday to schedule a phone meeting, a virtual Zoom, or an in-person meeting with one of our team of advisors. Start planning for your retirement now. That's 833-946-7384 or visit our website, acresfinancialgroup.com. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.